So good evening, all the participants for today's session. We have two segments for the session today. One is changes in Form 3CD, that is our tax audit report. And another session is on the changes in the ITR forms from 1 to 7. So first, we will deal with the changes in Form 3CD. There are, in effect, 10 changes they have brought in Form 3CD. Not one or two are critical. Other than that are not major changes. So this amendment was all these amendments are brought in on 28th March, with notification number 23/2025. So here we go. So first we will finish the changes in Form 3CD. I'll finish my presentation. Then we'll have some time for questions and answers, if any, on Form 3CD. And then we'll move to the next part of the session on ITR. So the first amendment is on clause 12, where the existing clause didn't have section 44 BBC. This 44 BBC talks about reporting profits under presumptive basis for a non-resident who is operating a cruise ship. So it is 20% of the gross receipts is as per the provision. So this one new section they have added to this clause. And actually, this same changes in the form also I have highlighted. So what I thought is first we will go through these amendments and then I will show you the form where the particular amendment is, how it is getting reflected. So this is unless if you have any client in this category who is doing this category of business, then please make sure that this is getting reported in your tax audit report. Next is a consequential amendment of sections being redundant. So 32 AC, 32 AD, 35 AC, and all these are omitted, and 35 AC have been omitted because the timeline for compliance or investment as it is have been expired or has been phased out over a period of time. So these clauses, the reporting under these clauses being redundant and defunct, these clauses have been removed. Then clause 21. So here, there was a notification dated 38/2025. They notified, as you know, at present under section 37, there was a disallowance of the penalties. Any payment made in the nature of penalties for violation of law or non-compliance of the law was a disallowance under section 37(1), which is a general clause wherein expenses incurred wholly and exclusively for the purpose of the business are being claimed. So if you remember in the form, we had, as tax auditors, we had the responsibility to report on personal expenditure, then expenditure at clubs, then advertisement expenses, so on and so forth, advertisement in political parties, souvenirs and all. In this, they have brought in one additional reporting, where this is a consequential amendment of explanation 3 to section 37(1). Expenditure incurred to settle proceedings initiated in relation to contravention under such law as may be notified by the central government, and central government has notified this. So as per the notification, the expenditure incurred to settle any proceedings under these four statutes is not allowed as an expenditure. So when we do the tax audit, please make sure that if any of these expenditures are debited to the profit and loss account, and we need to just make sure that this is being reported in Form 3CD. Consequently, correspondingly, the change should have happened in the computation also. We should advise the client. So these are the 4 acts. Please make a note of this. There is a notification. Then next amendment is the replacement. There was clause 22, wherein our responsibility was to report on the interest on the delayed payments to the creditors, which are under the MSME Act, micro and small enterprises, where there were delay in making the payment to the creditors categorized under this act. We had a responsibility to report on interest, but now the whole clause is replaced with a detailed reporting on interest as well as the original principal amount which is outstanding for payment beyond the period specified as per MSME Act. So as you know, section 15 and section 23 of MSME Act is relevant in this case. So one is the actual principal amount. So as per the MSME Act, as we all know that there are situations where if there is no agreement, 45 days is the criteria. If there any specific agreement between the parties, then that number of days is the criteria. So this we have to make sure here this reporting of including the principal amount has to be reported in clause 22. So here there could be some questions which is coming in a case where where we are the statutory auditors as well as the tax auditor. Our challenge may not be so much because we would have done the audit of the books of accounts, a detailed audit, and we would have gone through the process of checking the registration, MSME registration certificates and calculation of interest and classification, calculation of the amount outstanding, so on and so forth. But in those situations where we are only the tax auditors, not the statutory auditors, so the financial statements is already signed and the classification is done. And in that case, what is our responsibility? To what extent we have to, can we, question number one, can we just rely on the classification as per the statutory auditor's report, or do we have to do the original checking of the classification? Point number one. Point number two, if the company has accounted the interest, made a provision or actually made the payment of interest, of course, we have to, as a tax auditor, we have to definitely check the calculations. In case there is a difference between our calculation, ask for a clarification from the management. And we need to report the, as you know, the tax audit report is a true and correct report. So we have an obligation to report the correct interest with the relevant observations or relevant comments. And you can take a management representation also in this regard, on what basis the assessee has done the calculation. If the explanation given by the assessee is satisfactory, we can take that stance. Or if we have a different opinion as a tax auditor, we have to do the necessary reporting here. Same way, even the repayment of principal, the way they have adopted to calculate the outstanding bill to bill from the date, actually they use an expression appointed day as per the MSME Act. So appointed day is the date of deemed acceptance or acceptance. So all those appointed day calculation, how the delay in payment has been calculated. See, we have a choice here depending upon, you can do a sample test, and if the method adopted is satisfactory, no problem. In case based on the sample, we understand we have a difference of opinion, then necessary reporting has to be done or written representation also has to be taken. So here I want to bring to your attention that this particular point which I have discussed have been discussed in our guidance note on tax audit by ICAI. They have clearly explained what is our responsibility as a tax auditor. So it will be helpful. You can go through that. I think 13.5 on para and para 42 is talks about the reporting requirements of a tax auditor in MSME classification. So here, this is one thing which you have to pay attention when we do the tax audit this year. So perhaps more work and more attention to details, including the payment of the principal amount, is warranted because of this amendment. Next is clause 26. So here there is an amendment of a grammatical correction which has an implication. It's like first the sentence says in respect to, so what I have cut is something they have removed in the new form. I'll show you the form. So they say this is the new way you are going to see this is the way we are going to see the clause in the new form in respect of any sum referred to in section 43B. That the clauses they have removed, and it is coming in the next clause, actually next subclause, the liability for which the rule remained the same. It was pre-existing on the first day, last year's disallowance, and this year it has been paid or not paid, and also whatever incurred during the current year in those category of payments which are actually allowed only on payment basis. As you know, the section 43B talks about a situation where the deduction is allowed only on payment basis. So this reporting we were already doing. So the change is, the earlier form was using the word not allowed. See, it was using the word pre-existed on the first day of the previous year, that means opening balance, but was not allowed in the assessment year of any preceding previous year. Now it is replaced with the word not allowable. Maybe little more precise this is, because not allowed means it was possible for the assessee to claim as an allowance, but it was not allowed. But that is not so. The section is very clear. Unless it is paid, it is not at all allowable. The allowability comes only on actual payment basis. So that correction they have made, but was not allowable in the assessment year of any preceding previous year. And for clauses other than clause H. So clause H of section 43B talks about MSME payments. So now since including the principal repayment and also the interest payment has been specifically addressed in clause number 22, which we saw in the earlier slide, that is removed. That reporting requirement is removed from this particular clause. So this is one amendment which you have to pay attention to. Next, these are again consequential amendments because of the change in the original section. As you know, the amendments related to angel tax provisions and also 56 to 7A, which was for a definite period, and after that period, now the whole thing is addressed in 56 to 10. So as a consequential change, these two clauses have been removed from the tax audit report. Next amendment is about our reporting requirement under 269 SS and 269 T. Here, as you know, any payment made other than by way of account pay check, account pay draft for an amount exceeding 20,000, we were expected to report the details like name of the person, PAN number, amount of loan accepted, and in the case of 269 T, it is repayment. So 269 SS, as you know, has three components. One is loan or deposit, then another is specified sum. And specified sum is defined under section 269 SS as any advance relating to immovable property transactions. Otherwise, advances other than those relating to immovable transactions will not come within the purview of 269 SS. So if you remember the form, I'll show you anyways. There was two parts. Clause 31 A, B, C. Actually, clause 31 talks about loan or deposit and all the particulars relating to loan or deposit. And clause B talks about specified sum and all the details pertaining to specified sum. That is how we are expected to report. Then 269 T related reporting comes in clause C. So here, the amendment is actually critical. The earlier form was talking about the sentence stopped at this, like amount of, so clause 31 subclause A. The first point number 1 talks about name, PAN number and all those details. Second question is like amount of each loan or deposit taken or accepted, right? So it was only up to this in the earlier form. Now they have brought in a drop down, which I have in the next slide, where we have to identify the category in which this transaction has happened, which according to me will pose a lot of challenges. See, in earlier tax audit reports, we used to have this challenge and we used to make disclaimers, and also we used to write like saying that those transactions which have been effected by way of journal entries or those see, for example, there will be a loan taken, but actually it may not be a cash, it may not be a bank transaction. It may not be a cash transaction also. It could have been a journal entry, right? So we wanted to make sure that there is no penal consequences on account of that number. So we used to write saying that this is a journal entry and this is the transaction. That is what we used to do. And in those cases where the transaction has happened by way of a non-account pay check, we used to write a disclaimer saying that, see, we are not able to make out this from the bank statements, because whether irrespective of whether an account pay check has been given or non-account pay check has been given, the name appears, or either the name appears or the name doesn't appear in some bank account. So depending upon the bank, we will not be able to make a reporting. And also after this, of late, as we know, more digital transaction, more NEFT transaction, RTGS, there also we have this challenge. In some bank only the transaction ID comes, the name of the person may not come. So all this we used to navigate through relevant disclosures, right? Now, so to plug this, they have come up with a drop down. So if you go to the next slide, I have replicated in the original notification, they have given this as in the notification, this disclosure is there. So now, I mean, these categories are given as a drop down. So in the form, the utility, I think it will come as a drop down, and we need to choose the category in which the transaction has been effected. This, according to me, practically, it will take more time, and perhaps we should start our audit a little earlier to go through the transactions. So the various categories which they have, to my mind, they have envisaged all the possible way an entry can be brought into the books. Cash payment, cash receipt, easy, we can do this, not a problem. Next, payment through non-account pay check and receipt through non-account pay check. So here, as I told, this challenge was always there. But now, since they have brought in by way of drop down, to what extent we have to, I am not sure if we can just make a disclaimer and get away. I think they don't want that. That is why perhaps they want us to do a mind sweeping of the bank transactions. But still, I can't imagine. I mean, from the bank statement, how we are going to able to get this information is a matter of. I mean, it's a challenge thing. See, going forward, we can advise the client to keep a record of transactions, but this we are talking about the transactions where the books of account have been closed and the transactions have already been, it's done. So this we have to really apply our mind. We have to find a way. Next, transfer of asset or transfer of liability. So this category of transactions from here onwards, if you see, all these would have appeared by way of journal entries, transfer of asset, transfer of liability, then conversion of asset, conversion of liability. So where there was a liability other than loan transaction, which is converted to a loan transaction, or in the case of an asset where there was a deposit which was in the different, say for example, I can imagine a situation where the assessee, the office was being run in the premises of an assessee, and there was a rented deposit transaction. It would have been a journal entry in the original place. So at some point, that rented deposit was converted to a deposit which the company or the firm or the firm has to give it back to the landlord, or any netting off of those deposit against the loan transaction that's possible. As between asset and liabilities, there is a journal entry. So all these transactions, we may have to have a detailed study, and we have to make sure the nature of the transaction is correctly reported in our tax audit report. Then journal entry debit, journal entry credit, and also if you have any kind which is not fitting in any category, they wanted to plug in that challenge also by mentioning that any other mode, any other both debit and credit transaction. So here any other mode, perhaps if there is no space in the form to write your explanation, maybe you can include that in another Word document and attach it along with the tax audit report. So here more attention is warranted in our tax audit this time. So going back to the previous slide. So this is the amendment relating to clause 31A, item number 2. Now, same clause 31. Here, if you see in the open sentence, A and B, they are saying. Clause 31 in subclause A and subclause B. Okay. Now, subclause A talks about loans or deposits that we discussed now. Clause B talks about specified sum. I'll show the form. Clause B talks about specified sum relating to immovable property. Now, the intention of this notification, this amendment is to bring in that classification as per the drop down for specified sum also. And we all understand specified sum is relating to the advance relating to immovable property. But if you read this notification, they brought in the same wording, amount of loan or deposit taken or accepted, and code of the nature of such amount as given in note 1. And they made this amendment both for clause A and clause B. That means even for specified sum, in the earlier form, that second clause this second question, if you see the form, it was amount of specified sum taken or accepted. But now we have to read that as amount of each loan or deposit taken or accepted. Same sentence they have replaced in both in point number 2 for both A and B of clause 31. This to my mind, it could be an error. Because any loan or deposit transaction, even relating to immovable property, would have already been captured in clause A, right? So there could not be a situation where loan or deposit relating to only immovable property they want to capture in clause B. That cannot be the situation. So to my mind, this is an error. Maybe we will wait to see if there is whether they come out with any clarification. Either they should come out with a clarification or better understanding of this reporting. Let us wait and see. At this point, I think there could be change, or there is a challenge here. Now, same clause 31, the next amendment, again, in all these amendments is basically to draw attention to that drop down, and we are expected to report the category in which the transaction has taken place in the books of account of the assessee. So 31 AB is about loan, deposit, and specified some acceptance, and 31 clause C is about repayment of again a loan, deposit, or specified sum. So here, any repayment of loan, deposit, or any specified advance. So here they use the word specified advance only, and code of the nature of such amount as given in note 1, drop down to be provided. So the amendment is this. Here, I think we need to pay more attention. This is one critical amendment. And this is the last amendment, 36B. This is again a consequential amendment because of the changes in the buyback related provisions. As you know, from 1st October 2024, there is a change, 115 QA and also 222F, where after 1st October, any buyback by the company, the gross amount paid by the company for buying back the shares is considered as dividend in the hands of the shareholder. And as you know, the dividend is taxable in the hands of shareholder. So there will be a corresponding TDS also by the company. And the amount of original investment, which is the cost. Initially, it was the whole thing was a capital gain transaction. We could have claimed it as a deduction against the sale value, but now the gross amount is being taxed as dividend under 2 subsection 22F. And the original investment will be allowed to be claimed as a capital loss by the assessee, which can be carried forward for 8 assessment years. So consequential to that amendment, now in tax audit report, they are asking us to report about any assessee has done any amount for buyback of shares. If yes, then amount received and original cost of the shares bought back. So this we need to pay attention if the assessee has any buyback transaction. One is from the books of account, and another there should be, if the buyback is after that 1st October, there could be a corresponding TTS also in the 26 days. So these are the changes with respect to 36 form 3CD. Now I will just show you the 2 forms. Just I thought it will be better for the people to appreciate when we see the form. So this is the, I will just change the sharing because it is in, I hope it is visible. So this is the new 3CD form. Wherever the amendments what we discussed is there, I have tried to highlight. So first amendment, clause 12. If you remember, we discussed that form, that section 44 VBC, that presumptive profits from the operation of cruise by non-residents. So this new section has been introduced. Next, we saw that clause 19 has been omitted because of redundant sections here, 32 AC. In this, whatever redundant has been omitted, the 32 AC, 32 AC IA, 32 AD, and 35 AC is removed. So if you will not find 35 AC here. See here, asterisk they have given. They have removed. 35 AC is removed. Wherever removed, the see here, 32 AC, all those removed has been mentioned. Then next we saw that there is an amendment in clause 21. This is basically that section 37. So if you see here, after this perquisite reporting here, expenditure incurred to settle proceedings initiated in relation to the contravention under such law as may be notified. So as per the notification, those four act we saw, Depositories Act, Competition Act, SEBI, and Securities Contract Regulation Act. Then next is clause 22. So if you see here, MSME. So earlier form had only amount of interest admissible under section 23 of MSME. Now they have included the amount required to be paid and paid within the time limit under section 15 and not paid. So this is the way it comes in the new form. And in 43B, as we saw, that allowable word has been introduced and clauses other than 43H. So if you see here, and for the clauses other than clause H of 43B, that is the amendment. Clause H talks about MSME payments. Now, clause 31. So, the first amendment, clause 31A, particulars of each loan or deposit, and point number 2. So, earlier form had only up to this, amount of each loan or deposit taken or accepted. Okay, and this new thing is introduced. I have the old form. So here, see, loan taken or accepted, whereas here it is that drop down table is introduced. Next, so this is clause A, 2. Now coming down, clause B, pay attention here. The question is particulars of each specified sum in an amount exceeding the limit, that is 20,000, which is taken or accepted. And consequential question in the old form, I hope people can see this old form. If it is not visible, I will read out. In the old form, the second question is amount of specified sum taken or accepted. So just they had to add this code of nature of sum only, but instead they have put the same sentence, amount of each loan or deposit taken or accepted and the code of nature of the amount as given in drop down. So here I doubt what is the intention of the CBDT, I mean tax authorities. Now this is another amendment, and the repayment, this is again, this is fine. They are asking us to report based on the drop down. So the drop down also comes as a part of the form. And the last amendment, 36, is buyback. So these are the amendments for Form 3CD. So this is the end of session 1. If you have any questions, let me know at this point. Otherwise, we'll move forward to ITR, changes in ITR. So if any question is there, you can put it in your chat box. You can see audible. I'm not seeing any questions. Okay, I'll move forward. Let us, any form submission required for 36B. As of now, in the notification, they have not mentioned anything. Even I couldn't, they have not mentioned anything. So any sum payable by the assessee to micro MSME beyond the time limit specified in section 15 of the MSME, the word beyond is used. Whereas clause 22.2, the amount paid during the year as per section 15 of MS. So this clause is exhaustive. Yes, it looks like that. So here basically we have to, the time limit has a meaning, sir. Definitely whatever paid with, see, the sum and substance of the statutory requirement is it should have been paid within that applicable due date. Whatever not paid within the due date is not claimable as expenditure. I think we should read that way. So no more questions. I can't see. We'll move to the next session. After the session also, if any questions on this is there, I'm ready to take. No problem. So now let me close this session. I hope this is visible. So here I have close to some 170 some slides, but see, we tried to bring in the particular table or particular question, particular reporting requirement in the respective form. What we did in our office was we compared the old form and the new form, and wherever there are changes, we tried to highlight it. So I thought I have included it as a part of this presentation. That is why we have so many number of slides. So if time permits, we'll have a quick, I mean, we can quickly browse through it. Otherwise, you can see that. And I think once we start filing the return, very unlikely, unless there is a doubt or somewhere we are stuck, we'll go back to the original form. So that is why the number of slides are so much. So changes, as you know, the changes in ITR form are the consequential. Again, they are the consequential of the budget amendments. Whatever amendments brought in by the budget, the return will reflect the reporting of that amendment, that impact of that amendment. So the major amendments, if we remember in Finance Act, there were two like some vote on thing was in February, and there was Finance Act number 2 in 2024, whereby if we remember, we all recollect that the major amendment was on account of capital gains. There was a change in the treatment of the capital gain transaction. So the amendments, though they were intended to be more simple and more flexible, the impact of those amendments are much varied, and that impact is on account of that it can be on account of change on account of the change in the category of the assessee, individual versus company, or residential status of the assessee, resident, non-resident, then category of the asset, because the provisions, land and building has one set of provisions. Other than land and building, they made a relief for land and building. So category of the asset. Then again, period of holding, short term, long term, they changed with the rates. Short term capital gain rates changed, long term capital gain rates changed, with indexation, without indexation. So I'm saying, though the amendment was pretty simple. First, when we read, it was so pretty simple that any sale after 23rd July, there is no indexation, and then they came with a relief measure giving the benefit of indexation, which are at the option of the assessee for computation purpose for land and building for resident assessees. The impact of that is reflected in ITR, where everywhere where there is a reporting requirement for capital gains, I'm telling this you will find invariably in all the IT returns where we have to report capital gains, the up to July and after July. So collecting the information is really a challenge. That is the one major thing. And also then buyback related information, then small things like bank accounts defunct, all those things that we will see going forward. Here I thought we will just touch the base to start the session. Now there are 7 returns we are talking, ITR 1, 2, 3, 4, 5, 6, and 7. And first bucket, we will bifurcate ITR 6 and ITR 7. It will be applicable for non-individuals. ITR 6 is for companies, and ITR 6 is for companies, and ITR 7 is for the organizations having 12A approval, income tax approval. Then ITR 1, ITR 2, ITR 3, ITR 4, individuals, HUFs ITR 5 is for association of persons, partnership firms, LLPs. That is how it is classified. So I know the software, whatever we are using, third-party software helps us to choose the return depending upon the category of income, depending upon the category of the assessee, depending upon the residential status of the assessee. It helps us to choose, but I thought it is just a good thing to just touch the base. So here we have tried to just quickly go through what are the returns for each category of individuals. So ITR 1 resident individuals, again RNOR cannot use ITR 1, and income up to 50 lakhs. Here one change, that is capital gains they have brought in. I have another slide which is summarizes the changes in the ITR. This is, as I told you, which return to use for what category of income and what category of people. And ITR 2, again, individuals and HUs having no business income. If they have business income, then we can't use ITR 1 or ITR 2. We have to choose between ITR 3 and ITR 4 depending upon the residential status and also the reporting under presumptive or non-presumptive. Then ITR 3 is, as I told you, business income. Then ITR 4 is where business income and the assessee choose to go for presumptive, but the total income again should be within 50 lakhs. If total income is above 50 lakhs, you can't use ITR 4. Again, if it is an RNOR, you can't choose ITR 4. So there are its own challenges depending, the form will change depending upon the category. ITR 5 for firm, IOP and all, ITR 6 is for companies, and ITR 7 is for the entities with income tax exemption. It's income tax rule 12. Next here, I have tried to bring in the major changes, a summary of the changes across all the ITR forms, wherein we can actually, the whole idea of this session by KSCAA is to get us ready, prepare for the season, because we hardly get, all of us have equal challenge because we hardly get 1.5 months. Last quarter TDS will get reflected only by second week of June. So the return actually filing time we get is only 1.5 months, and last 10 days of July, we will be the victim of the server being busy. Given that situation, and the whole resources, how much ever resources you have, how much ever is the scale of your office, the challenge remains the same. So considering the fact, we tried to put this summary to start the preparation early, ask for the data before, because I'm imagining, as I told you, capital gains before July, after July, then there will be a situation where on 23rd July, then whether the statements what we get from PMS, all those, that portfolio managers and all, whether it gives that data in the way we need. Otherwise, we need enough time to go back to the client and ask for the data what we require. So here is the summary. ITR 1. So these are the changes. This is based on the comparison of ITR 1 for the previous assessment year and the ITR 1 for assessment year 25-26. Reporting of long-term capital gain. In earlier ITR 1, there was no reporting for capital gains at all. If you have capital gains, you have to go to ITR 2. Now up to 1.25 lakh, which is the exemption limit, which they have enhanced, there is reporting. You can report in ITR 1 if all other conditions satisfy. The person has only salary income and one house property and only interest income. Then if the capital gain is only up to 1.25 lakh, then they can use ITR 1. Then another major change, which reporting of bank account. This is there in all the ITRs, not only in ITR 1, where we know that we give the details of the bank accounts, all the bank accounts which the assessee has, that they have specifically mentioned that defunct account, inoperative accounts, we need not report. This always we used to get it out when they say all bank accounts should be report inoperative accounts. So that we don't have to report, but take it as an opportunity. Here, yes, reporting requirement is only operative accounts, but one extra value add service for our clients, what we have to do is advise the clients to close the inoperative accounts. This is nothing to do with IT return filing, just a practical help. As we call ourselves as service providers, that is one value add, because client may not be aware of that holding that inoperative account. So this opportunity you take and tell the client that please check if you have any inoperative accounts. If you don't need it, please close it. Most of the time they will have some inoperative accounts, so please close it. Actually, we don't have to bother about inoperative account is the amendment, but I'm telling this service you can do. Then another new amendment is, earlier those who are familiar with third-party software like Winman or Sarel TDS, when we were reporting the TDS deducted, I mean the asset, as per 26 AS, we used to import in the ITR form. We used to, the software used to ask under which section the TDS has been deducted, whether 194J or 194C or 194I or whatever. But the form, that section was not appearing. If you see the form, you generate the form, only the amount was coming. Now they have brought in the section. Now this has an impact in my view, because especially I'm imagining a situation where the client, say our client is a consultant, or rather he's a consultant, a professional consultant who is eligible to claim a presumptive benefit under section 44 ADA. But the client who paid him the consultancy fee has done a TDS under 194C. Now, here I'm thinking that assessing officer can come back and say that that 194C is not a professional income. It should be under business income, cannot give the benefit of 44 ADA. Or the other way can also happen. It is actually a business income. We claimed 44 AD, but the TDS happened under 194J. So the assessing officer can say that this is a professional income, cannot claim 44 AD. So here it is a bit critical. Now, whatever happened for financial 24-25, there is nothing much we can do about it. But at least going forward, bring this to the attention of the client, saying that there could be a consequence. Always it comes like that. First they will introduce and then we will face the consequence. So just to get alerted to this. This change has an impact. It may not be a punishing thing, but it may have a long-term impact in my view. Then another change, this also is there in all the returns where we report interest income, where the drop down, savings account, deposit account, that category they are asking us to choose. They are giving a drop down in the utility, and you have to choose which the category of the interest. So in this context, since we are discussing interest, I want to bring one point that NRE interest of non-resident assessees. For want of time, if we don't get time to discuss, I thought since it's coming to my mind, I thought I'll bring it to the attention. See, NRE interest, which we came across very recently in our office, where NRE interest of non-resident customers, non-resident clients. See what happens for non-residents, if you know, the TDS happens on NRO account deposits, NRO savings account as well as NRO FD account. The TDS happens under section 195, which is that data we get from 26 AS, and we file the return reporting interest income. If they have any other rental income, or that we'll consider. This NRE interest, since being an exempt interest, no TDS happens, and that information is not available in AAS or 26 AS unless we specifically ask the assessee to get us the details of NRE interest. And since it is an exempt income, see, we need to report the exempt income. So if we choose not to, so see, practically, if we don't get the data, we choose not to report it. Finally, if we take a call, no tax impact, it is revenue neutral. And NRE interest, if we don't report, we file this return. Now, no problem as far as Indian tax is concerned. This is again a value-add service which you think when you render service to a client. This assessee, suppose now this non-resident assessee will have an obligation to file tax return in the place where he is in UK or US, whatever, whichever country he is in. There, he being a resident, he has a responsibility to report the global income. So most of the times the client will come back and ask us to give us the data of the Indian return filed, reporting the Indian income. And we give, when they have a different financial year, we give the data, we calculate and say that from Jan to December, this is the interest income and TDS and all the whatever other income reported in India as per the Indian tax return file. Unless we are very alert, NRE interest we may not give because it is not a part of IT return. But as a person who is a resident in another country who has a liability to report global income, he has to report that NRE income in his NRE interest income in his return in the country wherever he files the return. So, and it may not, there is no foreign tax credit also because there is no tax deducted in India. So it will be purely taxed in that country. If he doesn't report this, there is a double tax in the sense the income is not taxed in both the countries, neither in the resident country nor in the source country. So this, the client may not be aware. I mean, they being non-residents, they may not be so well versed with the tax provisions in India. Being CA, chartered accountants, we we have to bring it to at least take a look at if you have any client who has any consequence of this interest income. That is something which you can do as a part of this tax season. Coming back to our discussion, retirement benefit account, that 401k account, there was an amendment where they introduced section 89A, wherein so far they have notified 3 countries, United States, USA, UK, and Canada, where the retirement benefits. See, when the person is resident in that country, it would have got accrued, but they can withdraw it only after a specified age. And when the taxation, to avoid double taxation, how to go about it. When after that they relocate to India and they become resident in India, what are the implications? So anyway, this was all along there. This is not an amendment, but this is something which we have to pay attention then when we file these returns. Then this has relevance. Why I thought of bringing in, because this information may not be available in our AIS or 26A. So sometimes for simple returns, we will take the data only as per 26AS and AIS and we file the return. We may not see their bank statement. So this category of information may not be available from the income tax portal. That is why I thought we should bring it to an attention. This is not an amendment as it is, but I thought since we are discussing on IT return, I should bring it to an attention. Then ITR 2 major changes. So here onwards, the major change is on account of the amendment in capital gain provisions, wherein, as I told you, the difference on account of change in the category of the assessee, then differential rate with indexation 12.5, without indexation 20%, then computation considering the number only for computation purpose, and up to July, after July, and buyback details, then pass-through income details, all those are the new amendments. So if you see date of purchase and date of sale for short-term capital gain, they are asking. Then for all categories of capital gains, details of transfer before July and after July. Pass-through income or loss in the nature of short-term capital gain chargeable at 20%. Capital loss on buyback of shares after 1st October 2024. This we saw in the 3CD amendment also. Then short-term 20%, 30% at applicable rate. Long-term 12.5%. Then 10% under 115 AD. And buyback again 222F dividend. All this are reflecting in our IT returns, which are consequence to the budget amendments. Again, cost of acquisition and improvement. As you know, she gave a relaxation for those assets acquired before 23rd July. There is an option where person can compute with indexation, without indexation and beneficial portion, but that is only for computation purpose, not for taking a decision for investment under section 55. Pass-through income reporting. Pass-through income 115 UA is really a challenge. Now we are getting to see more and more people getting this category of income. So in the ITR, there is a separate table for reporting pass-through income. So make sure that the income is not doubly reported. Here you have a challenge also, which we are also facing. In the sense, TDS will happen in the name of the person who is the legal owner. But actually the income belongs to the beneficial owner. So if we have to claim a TDS, we have to mention the PAN number in which the TDS has happened. In 26AS, it will happen in the name of the legal owner. So here really we have a challenge. That is not an amendment, that was all along there, but pay attention. Dividend income under 222F. This is the consequential amendment of buyback provisions. Then ATU in ITR 2, they have brought in a new table where the person with a disability, there is a department of empowering the disabled people. There is something called UDID number, unique disability identification number. And also there is a form associated with it. So there is a detailed question on whether form that a certification by the medical practitioner, that is form 10IA, and there are questions. I'll show you the table when we go to ITR 2. So here it is something new. Pay attention. Then another major relief, I should say, is a really relief where assets and liabilities, as you know, we had a requirement to report the asset and liabilities when the total income is above 50 lakhs. Now they have relaxed it to 1 crore, which is a very, very welcome change. Then the others, another interesting, or rather another major change. This is also there in almost all the returns where we have capital gain reporting. Unutilized capital gain deposited in capital gains account scheme related disclosure. So there is a table where they have mentioned the assessment years, and if any withdrawal, date of limitation of withdrawal, so we have to calculate. There is a 3-year timeline within which the money has to be utilized, and unutilized money is taxed under capital gains. So this is a new table which they have introduced, wherein you may have to go back to previous assessment years and find out where the assessee has deposited money in capital gains account scheme. We have to see if the money has been utilized. See, always, I don't think, very rarely we go back unless the assessee wants to withdraw money from the capital gains account scheme. Very rarely we question that, because the assumption is the money has been utilized. So it will be a good, now we have no choice. Wherever there is money parked in capital account scheme, please check the status and advise the client accordingly. And there is a reporting requirement if there is a withdrawal. Pay attention to this table. ITR 3, again, capital gain related disclosures. So going forward, ITR 3, most of the things are same as previous ITR 2. Assets liabilities disclosure, retirement benefit, savings interest, then capital gains related changes, ITR 5, buyback related changes. Yeah, in ITR 6, again, that 44 BBC. These are the summary of the changes. So what we have tried to do is like this. So this you can, since it's almost 5:25, this is the way we have tried to highlight the changes in the respective return forms. So you can go through this. Definitely, this is just to bring it to attention what kind of question. So you can see how the question is appearing for reporting. So we have tried to highlight wherever the new sentences or new form it is appearing. Another major change, which I think this table just I wanted to show, where the switch in that a new scheme, old scheme option, where you have, see, if you remember, for business people, it was one-time option to switch out between new scheme and old scheme. So this comes in ITR 3 and ITR 4. There is a separate table relating to the exercise of option between new regime and old regime, where they are asking the date of filing form 10 IEA. If you remember, we had to file a form for business people. So this is something new, detailed information they are asking. Other than that, you can go through at leisure. So I was doubtful of going through everything. That's why I thought I'll make that summary so that I can bring it to your attention what are the major changes. Now it is 5:25. Before closure of this session, ITR 7 also, again, capital gain related changes. Now I want to, now these are as far as the changes are concerned. So this is the table. If you see that capital gain related account scheme, capital gains account scheme table, see there is a question. See, if you see the question, whether the date of limitation of the withdrawal before 23rd July, and they're asking the previous assessment years, because the 3 years limitation period will get over by 31st March 22 means by 2025 they should have utilized that money. So this is something pay attention to. We have to pay attention to. Now, before the winding up the session, I thought this is an opportunity, as I told you. Now the next 1.5 to 2 months is challenging for all CAs. So next 2 slides, I thought whatever we have come across in our office, what we have to pay attention to. Some of the things which we have to pay attention to make sure that we file correct returns, because see, we always think tax audit is very critical. At least in our mindset, we used to think in the earlier days of practice, at least we think July is a relaxed, compared to tax audit period, it is much relaxed. Tax audit is supposed to be more critical, but that times have really changed the last few years, because even a basic return warrants an attention of a partner. It cannot be finished by a CA final student, because the questions are very critical, and if any wrong answer given, we are getting notices. So every return is true and correct. So that way our liability as chartered accountants is, see, just because you can't say that we are not signing. I'm not a person who will buy that argument, because Signing is, yes, one kind of responsibility is high, but if we agree to a client that we file your tax return, the accountability is very high. We can't say that we don't sign, we can run away. See, we can say that we relied on your document, we relied on your words, we relied on your email. All those are fine, but we can't say that we have not signed. I don't believe that. We should not be that also. That is what is called as service. So please think that every return is true and correct. With this in mind, what certain things what we have come across, I have tried to highlight. These are the things which we have to, adopt as a policy, or maybe be alert to this situation. Refer last year return. First, make sure when whether it is first year article or final year or even a partner for that matter, keep last year as a basis. That is always helpful. Even if it is phenomenal change, we should know why. See, there could be change in residential status, there could be change in general information, there could be change in the category of income, many changes. So always refer last year return. In case the client is new, please, we have the facility, we can download ask for the previous year return details, commutation, so on and so forth. Then next, rectify them. Suppose you are working on a return and you find that there were some mistakes which was reported in the last return, previous year return. When I say previous year return, 23-24 return, you find that there was a mistake. Now, what you should do if you are if you don't know the history of the client, don't unilaterally do that rectification, because there could be something which has been retained based on a stance taken, because as you know, our subject is subject to interpretation. There are a lot of interpretational issues, and for want of information or circumstance, some decision would have been taken, some stance would have been taken in the previous year, or based on the notice received or assessment, some stance would have been taken. So never correct unilaterally any mistakes or anything which you don't understand or you expect. I don't call it mistake. You expected it to come this way, but it is coming this way, especially carry forward of loss or something which has a consequence in the previous year return. Never make a unilateral correction. Please make sure that this is brought to the attention who knows the attention of the person in your office, who knows the history of the client. Don't do it unilaterally. And whatever has been done, if the person previous to you who has worked on it return had done a documentation, for want of time for that matter, there should be, see, that return would have got filed under so much stressful situation on last day. The person wouldn't have been able to document it. Now you have got an opportunity. Please take some 5 minutes time and document what is the stance taken, which will be helpful for future person who is working on the return. Next, during the filing season, if time permits, checks the status of assessment. This is another value add service for which you may not be paid. Mentally get prepared for that. That is what we call as service professionals. See, there are certain offices I know, they have a software where every assessee is mapped into the software and it will throw the assessment if they have any notices or any queries from the department. But suppose your office doesn't have that software, then this is a time, especially for individual returns, we may not go to that portal again and again unless there are some queries, or for advanced tax calculation. Please see if just another 5 more minutes you may get, especially if you're working in June and maybe up to 3rd week of July. Last week of July, I'm sure if time permits, you do it well and good. If you don't time permit, at least after July, you do this. See that e-proceeding. There are many places nowadays, the notices come. There is a work list, there is a response to, there is an outstanding demand, there is a compliance portal, some comes in e-proceedings. So just take a look at it. Or there could be a situation where you have applied, you have sought a rectification which has never happened, that outstanding demand still remains and interest is mounting. So if your office has a system to track it on daily basis, no problem. If your office is not that, please take an extra 5 or 10 minutes to see if there are any critical things to be addressed. You don't have to address it now. If it is not time bound, don't address it now, do it after July, but make a note of it. Pay attention to general information. This is very critical. See, people's name would have changed, address would have changed, email ID would have changed, phone numbers would have changed, and residential status would have changed. Many things would have happened in life. This is 1 year time we are talking. There could be a situation here, the previous data was wrong also. So please pay attention to general information before filing the return, discuss with the client. Next, residential status. This is very critical. See, nowadays we are getting that if people who have worked the number of days in the that condition for residential status, section 6, whoever has read Income Tax Act, it is very critical how we calculate the number of days, right? So even 1 day can make a difference. And nowadays you see there is a deemed RNOR status. If the person is income is exceeding 15 lakh, and if the person is a non-resident, it becomes RNOR. or number of days coming for a visit, 120 days. There are many number of days in the calculation of residential status. So this number of days calculation is very, very, very critical. If the, see, we are getting notice, summons under section 131 1A where, they are asking, now there is something called tax information exchange agreements between countries, between India and other foreign countries, where they get the information that the person has some financial interest or they have a bank account in a foreign country. And we are getting someone saying that, see, look, we find that there is a bank account, and see, please prove us whether this is reported in the return. And we wouldn't have reported because the person was a non-resident that financial year. Now they are asking us to prove it. We can't simply say that it was a non-resident. They are asking us to send passport copies, So it is a very critical thing. Pay attention to this because we have a tendency to focus only on the numbers. It is not a mistake, but this is also important because all of us are working under stress. This, whatever I'm talking, is as well applicable for me also. When we work under stress, certain thing we take it for, we may not pay attention as much as it warrants. So please pay attention to this. Next, pay attention to the limits of calculation. This is again, see, 15 lakhs, as I told you, if a person who is a non-resident, basically a person living in another country, whose income from Indian sources exceeds 15 lakhs. And the person is living in a country where this income is not subject to tax. Suppose that person is living in a tax haven. Then this 15 lakhs is a very critical thing. And you have an information that his income is 14 lakh 95,000. Please make sure that computation is very, very correct. Because if it is 50, if the department comes to know that it is 15 lakh 10,000, then the whole thing changes, tax treatment changes, everything changes. So please pay attention to calculation of limits, especially when you are close to the border. Next, sharing ratio of income between joint properties, whether it is husband, wife, or brother, sister, or father, children. That ratio, previous year, what ratio was reported? This is very, very critical when somebody was reporting a rental income and it was shared between, say, 75-25. Now they are selling the property. The TDS has happened in a different ratio. What is the implication? TDS would have happened to 50-50. Whether there are any implications, please pay attention to that. Just simply don't do it. Please pay attention. That's the next point. Capital gains property. Again, somebody is selling a property. We'll compute the capital gain. We'll put indexation, without indexation, advice or exemption, everything we'll do. But whether the property, 1 minute you see, whether the property, see, if the income was more than 50 lakhs, it should have been reported in the return. Less than 50 lakhs, what was the status of that property? Whether it was see, we may not have asked the question, or we asked the question, the client didn't think. See, we have a case where the client thought that inherited property is not at all his property. And if we had known, we would have advised him to declare deemed let out property, because it was additional property. I think it was its 4th property. The assessee was thinking that it is not his property because he never paid for it. Right? Now, he sold that inherited property. This is a practical case which we came across. He sold the property and we asked him what was the status of this property all along. He told it was let out. That rental income was never reported. Now there is nothing much can be do about it now, because at least mentally get prepared, or right, when you work on such things which cannot be, there could be some problem which have no solution also at this point, because you have to file the return by July 31st. So at least bring it to the senior person. They will, some judicial precedents we can rely on, or whether we can rectify the previous return. How grave is the mistake? Please make note of it and write what is the solution. Next, ask details of exempt income. This is also very important, because some major thing would have happened in people's lives, right? Some big amount would have come as gift or inheritance. Somebody would have sent, some repayment of loan. Find out, see, if we are these cases, we may not see the bank statement, means ask if any major transaction happened. Like, don't stop at any major transaction, because what we think major, they may not think major. So ask any major money, like above 5 lakh or above 2 lakh you received. Did you get any gift or inheritance? This is very critical, because it is an exempt income. Actually, there is we are supposed to report the exempt income also as a source in the ITR. There is a place where you have to report exempt income with the nature of receipt. Suppose we don't report also, the person has utilized that money to buy a property and subsequently sold the property, then original source was not reported. Income tax officer can always come back and ask why this was not reported. And another most harmful is, assessee thought it is exempt income, but it was not exempt income. For example, dividend. Imagine, assessee thought that dividend income was exempt. Nowadays, thank God we have the sources to find out it. If we don't find it, and foreign dividends, ESOP on foreign ESOP's dividend income will not come in 26 years, and assessee is thinking that dividend is exempt, which is not. So please ask. Then pay attention to AS 26 not belonging to assessee. See, in compliance portal, the income transactions appear relating to assessee. Please go through that, and if some transaction assessee says that, please discuss with assessee. And if assessee says no, it is not at all my income. This is a classic example where the tenant vacated the property, but he continued to claim HRA, and it appears in the AS of the landlord, and then we have to go. There is an option to give feedback. If you don't know, take the help of people who know. You can disown that. You can say that this information doesn't belong to you. Very, very important. Then next, all this becomes critical at the time of assessment. First year client, ask the details of the previous return. Find out. Then documentation for this already I told you. Document of stance taken, special treatment given to category of income or documents related. Again, stance taken, and also write based on what document. Did you rely on a judicial precedent, or did you read some article? If it is some article you read, please save a link of that article. Document it. Details of assets and liabilities reported. Be careful with values, because see, there is something called peak value for foreign bank accounts. Make sure you take the correct exchange rate and you are reporting the correct balance. Some wrong numbers you should not report. If you report wrong numbers, instead of 10 lakhs, if you report 1 crore, 1 0 only, but that 1 crore can draw, just because you added 1 0, it can draw attention to the officer and get notice. Please make sure, double check the numbers you get reported. Which gets reported, especially forex assets and liabilities. And is there any duplication? I understand in some form there is a requirement to report the number twice. Make sure that if the number is reported twice, both places same number should be there. Then details of unlisted shares, direct share partnership information. Another 5 more minutes. Can I take? I assume I can. Okay. So unlisted shares sold this year. Please check whether it was reported in the last year. Like details of partners, recheck the profit sharing ratio, other forms to be filed. Make sure the forms are getting filed before the ITR, because unless the forms are filed, you will not get the benefit of exemption or foreign tax credit, or even the benefit of new regime, old regime. Then residential status of non-individuals. Be very careful. If it is an HUF, father was resident in India, the HUF is resident in India, because affairs are wholly decided in India. Father passed away, son became Karta, son is non-resident, the affairs are fully decided by the son, then the residential status of HUF changes. Then, in the case of deceased partner, don't think that the Aadhaar number OTP will come, we can verify. Don't do that. Please add legal hair. There is a process to do add legal hair. Make sure you are doing that. Then disclosure of foreign bank account, pay account closable. So these are some of the things which we came across, which I could imagine. So this is, I wish all the participants best of luck. That we should be able to do best work as much as possible, best efforts, smooth tax season with maximum efficiency and minimal surprises. So thank you so much. Thank you, KSCAA. As always, every opportunity given to me as a speaker is the best opportunity for me to read. Thank you so much. Thank you for the participants.